Welcome dear students. I am Pooja Parishwad. This is the second video of income from house property. In the last video, we have discussed how to determine the annual value of house property. In this video, first we have take overview of determination of annual value. Okay. See, at the time of determining the annual value, there are two stages. First stage is determination of gross annual value and second stage is determination of net annual value. At the time of determining the gross annual value, you have to compare these four factors: municipal value, fair rental value, standard rental value and annual or actual rental value. There are three steps of determining the gross annual value. In the first step, you have to compare municipal value with the fair rent and take the higher amount. In the second step, you have to compare the amount from first step with the standard rent and take the lower amount. It is also called as reasonable expected rent. In the third step, you have to compare this reasonable expected rent, that is the amount from second step, with the annual rent or actual rent and take the higher amount. Okay. In the second stage, for determining the net annual value, you have to deduct municipal taxes paid by owner from the gross annual value. Then you will get the net annual value. This is the simple process of determining the annual value of the house property. Now, in this video, pro forma of let out house property and pro forma of self-occupied house property is shown. Let's see how to compute the income from let out house property. This is very simple pro forma. Here it is clear cut shown that first you have to determine the gross annual value as we discussed earlier. Then you have to determine the net annual value, and from that net annual value you have to deduct the deductions under section 24. Then you will get the income from let out house property. Okay. Here one point is necessary to remember. At the time of taking annual value, take actual rent excluding unrealized rent, if any, given in the problem. Okay. Also, if that property is vacant in the previous year, it is necessary to deduct vacancy period rent from gross annual value. Vacancy period rent can be deducted only if shortfall of gross annual value is due to vacancy alone, otherwise not to deduct. Now question is that means what? When to deduct the vacancy rent and when not to deduct the vacancy rent is the question. Now for that purpose, one simple trick you have to remember. What is that trick? See here. When gross annual value, that is GAV, is equal to annual rent, at that time you have to deduct the vacancy period rent. And if gross annual value is not equal to annual or actual rent, at that time you cannot deduct the vacancy period rent. This is the simple trick you have to remember. Okay. Now, after getting the gross annual value means this amount, you have to deduct the municipal taxes paid by owner. Here only paid taxes and by the owner you have to consider, not a payable taxes from any other party you can deduct from the gross annual value. This point is necessary to remember. That's why here the word paid and word owner is in the bold form. Okay, to remember this point. Then you will get the net annual value. From this net annual value, you have to deduct the deduction under section 24. There are two deductions. First deduction is standard deduction, which is calculated as it is a 30% of NAV, that is net annual value, which we already calculated. And second deduction is interest on housing loan. In case of let out house property, whatever interest on housing loan for that particular house property, you can deduct under section 24. There is no limit for deduction of interest on housing loan in case of let out house property. After deducting deductions under section 24, you will get the income from let out house property for that particular previous year. Okay. Now see the next pro forma, that is self-occupied house property. In case of self-occupied house property, you have to follow this simple pro forma. Annual value of self-occupied house property is always nil. Only one deduction under section 24 is applicable, that is interest on housing loan, if any. For a self-occupied house property, in case of interest on housing loan, maximum limit is given. Here, if property acquired or constructed with capital borrowed up to 31st/3/1999, the maximum limit for deduction is rupees 30,000. And if that particular property acquired or constructed with capital borrowed after 1/4/1999, the maximum limit for deduction is extended up to rupees 2 lakh. And here, after deducting this interest on housing loan, surely there is always loss from self-occupied house property. Okay, is it clear? Now there are two notes necessary to remember at the time of solving the problem of income from house property. First note is, if housing loan is taken for repairs or renovation and not for construction purpose, at that time maximum ceiling for interest is rupees 30,000 in place of rupees 2 lakh. Okay, the maximum ceiling in this case for the interest is rupees 30,000 and not rupees 2 lakh. Okay, and second note is pre-construction period interest. In case of pre-construction period interest in respect of self-occupied house property as well as in respect of let-out house property. 1/5 of pre-construction period interest is allowed as deduction with previous year actual interest paid or payable. Okay. These 2 points are necessary to remember at the time of solving the problem of income from house property. Okay. This is very interesting and simple topic. In the next video, we will take one simple problem and try to understand how to compute the net annual value of the house property in different stages or different cases. Okay. Thank you dear students.